Welcome to a special edition of SB Talks. Today I am joined by Stanford Brown Head of Accounting, Dean Crossingham. Welcome, Dean.
Hi, Vin.
Now, Dean, this is your first time to join us on SB Talks podcast, so I might ask you benefit the listeners by sharing a little bit of your background.
Yeah, absolutely. So I came across to Stanford Brown to run their accounting and tax practice at the start of 2020. And of course, everybody knows that Stanford Brown takes a holistic approach in managing their clients' financial world, and accounting and tax is a core component of that. So from the start of 2020, we've been managing the accounting and tax affairs for Stanford Brown clients. I came across from a director role at Deloitte Private here, and I've been a chartered accountant for 20 years, working in Sydney, helping executives, private business owners and their families managing their tax affairs.
Wonderful. Oh, well, welcome to the podcast. Now, the purpose of our discussions today, the core focus is on your employee equity plan white paper. I might start off by asking you to explain for us the genesis of that paper.
Absolutely. So that came about simply by way of many conversations we've been having with our clients just around how their employee share plans are taxed. People start off on their employee share plan journey with not much knowledge or education on how they're taxed, but they need to learn that very quickly, and especially when they start receiving their tax bills.
So you're helping them to avoid any nasty surprises there?
Oh, absolutely. And it's not just the clients with nasty surprises. So we work with clients across their entire journey of their employee share plan. So from young professionals who are just starting, that's where the nasty tax surprises may be lurking, but also more senior, seasoned executives who have been on their share plan for many, many years and decades, who are looking to, roll out of that and diversify into new investments, but also new financial goals in the later stages of their career.
And I guess that's where the employee equity plan sort of dovetails with the broader holistic offering at Stanford Brown and helping individuals consider, not just other types of assets, but other structures such as superannuation, family trusts, and things of that nature. So let's spill the beans, Dean. Share with us some of your top tips or some of your key learnings you've built up over the years in working with these clients.
Yeah, look, I think a key learning it's a key learning for everyone that I've spoken to about share plans is, firstly, share plans are not just taxed once; they're taxed twice. When you are a young professional starting on your employee share plan journey, it's fantastic. You're granted shares on your plan. You see in your brokerage account that your wealth is appreciating significantly. Bear in mind that under the taxation rules, that is subject to tax. So worth talking about how that is taxed. So in your assessable income, the discount on your share plan is included as your income. The discount is the difference between the market value of those shares at the vesting date and the amount that you pay for them. And generally, the amount you pay for them is nil. So what you find is the entire market value of each share is included in your assessable income and you pay tax thereon. That's the first taxing point.
And I might just pause you there because that's a major one. And unfortunately, from our experience in working with clients, not one that's necessarily all that clearly articulated to people on these plans by their employers upon occasion. And that's because they're scared to be in a scenario where they're deemed to give advice around managing tax and things of that nature. But you've dealt with individuals who've unfortunately retained the shares and suddenly then had a tax bill that they didn't know they were in for, or could perhaps even explain a scenario where obviously they retained the shares and they may be devalued and how that is impacted in their tax position.
Yeah, absolutely. So what needs to be appreciated there is that the market value of the shares at their vesting, assuming that's the amount that was the discount, is included in your assessable income.
So on that day, it's essentially locked in.
It's crystallized and locked in as your income. From that date onwards, you bear the risk of holding those shares if you choose to do so. Now, your tax return may not be lodged for 12, 18 months after that date. Irrespective of what happens to that share price, your tax has already been calculated already. So it can happen that when you lodge your tax return and pay your tax bill, depending on the market conditions, and we've seen some really terrible market conditions over recent years, the share price may be no greater than the tax you have to pay on those shares, and sometimes the share price is even less. So we end up with clients on the occasion having a tax gap after they sell their shares to pay their tax bill because their share plan at that date just doesn't cover their tax.
So if the share plan had potentially, the shares that they'd owned had potentially gone down in half or worse, then it could actually be less than the tax bill that they have. So
Absolutely.
I guess you're keen to make sure that people are at least conscious of making a decision, not finding themselves sailing into this situation somewhat blind or uninformed.
And that's just the first tackling point, Ben.
It gets better. It gets better.
There's more. So if you hold your shares and then you sell them, then you've got CGT. And of course, the CGT is the difference between the selling price and the amount that's included as your income under the employee share plan rules generally.
So taxing point number one, as you've articulated, is the value, market value at time of vesting. And then taxing point number two is when you do go to actually sell those shares. And it's then we're looking at the potential gain between point one and point two.
That's right. And if it's actually a loss between point one and point two, you'll have a capital loss.
Yep.
That cannot be offset against your other income, but it can be offset against your current or future capital gains.
Yeah. Excellent. So take us through some of the scenarios of how you help work with clients to navigate this world.
Absolutely. So look, it's always different. Firstly, there's just a conversation to help the client understand. The next is on a quarterly basis, depending if they're paying tax installments or not, we help calculate what the actual tax they need to pay on their vesting is. So they can quantify that, pay the ATO within the quarter, and be clean of tax going forward on that vesting. It may be the case that the client needs to sell shares in order to cover the tax. So again, we help quantify what tax they're due to pay, but also help them specifically select what parcels of shares that they can sell in order to minimise any CGT from their sale.
Do you mind unpacking that one a little bit further for us? Just explain what that means.
Yeah, absolutely. So for capital gains tax purposes, this is the second taxing point. You are able to select which parcels of shares that you sell within a broader shareholding. So for example, you may hold 200 shares in ABC company. You can select specifically number one share or number 77th share that you own to sell. So we go through a process with our clients whereby we track their cost bases, which is generally the market value as at the vesting date for those on the share plan. Foreign currency conversions also come into play. So we do a Forex, usually from USD to AUD, and we can accurately calculate and determine the cost base of each single share that they own. If the client needs to sell X amount of shares to cover their tax, we can select specifically what shares within their broader portfolio to sell to minimise any potential CGT. So those being the shares with the highest cost base after being converted to Australian dollars.
So fair to say this is not necessarily a straightforward exercise, or there's a chance to be quite strategic in terms of how you go about it.
Absolutely. And the general perspective there that I encounter is, well, I'll just sell the shares that are older than 12 months because I get a discount. They're not necessarily the ones that you should be selling to minimise your CGT exposure.
Any other key messages you'd like to leave us with when someone's considering their options in this space?
Yeah, absolutely. I always say that just remember that the shares you receive on a share plan, you don't receive them for free. You are granted them and they vest, but the amount that you have to pay, you pay by way of your tax return. And if you're on the highest marginal rate, it's effectively paying for close enough to 50% for your shares through your tax return. So there's a conscious investment decision there that if you had the cash in your pocket, would you choose to buy that extra parcel of shares or not? And if it is, you would not, then the alternative is to sell shares as at the time of vesting to recover the tax that you need to pay.
Yeah, and from an investment perspective, we certainly talk to clients around whether they want to have such a significant portion of their wealth held just in one specific stock as well. So it's all interrelated within the piece there. Dean, been excellent as always. Welcome to the podcast. No doubt we'll have you back again soon. You've left us with a key message. There's only two certainties in this world, death and taxes. So we very much look forward to your next installment. Thank you, Dean.
Thanks, Vin.
And thank you to everyone for listening. Take care.